Good afternoon. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. And for this special edition of Trade Talks, Scott Nations, he's the president of NationsShares, one of the top option strategists in the industry, CNBC contributor, and now author of the greatest book ever. Just kidding. A history of the United States in 5 crashes. And this was a fantastic read because it's a little bit out of your geeky wheelhouse.
Well, thank you. And the reason I wanted to write the book was because as a little bit of a student of history, I enjoyed reading about each of the crashes. And then you read about each of the crashes, the 5 modern stock market crashes, starting with the panic of 1907 and ending with the flash crash May 6, 2010. The thing that struck me as I read about each of these is the similarities. The similarities are really striking. And if you're a student of history and or the markets, then you think about what Mark Twain said. He said, history may not repeat itself, but it rhymes. And I think that that certainly happens with each of the crashes. And you see the similarities, even though more than a century passed from the first one, the panic of 1907, to the last one.
Of the 5, what was the most impactful to markets now?
I think that's a great question. The most impactful was probably the crash of 1929. Now, the crash of 1987, Black Monday 1987, the market lost about the same amount. I think why the crash of 1929 was the most impactful was not necessarily because of the crash, but what happened afterwards, and that is the Great Depression. I mean, we still have a few people alive who lived through the Great Depression and lived their lives in a way that they never want to go through that again. Another one that I think is really interesting, though, is the flash crash of May 6, 2010. And why is that? That's because the next crash is going to look a whole lot more like the flash crash. Largely algorithmic, little human intervention. The next crash is going to look a lot more like that than it will the crash of 1929.
And I agree with you on that because it changes market structure. It's not a specific event, nothing tied to history, nothing tied to economics. It really is a market structure issue. But my question to you is, have we learned anything out of these 5 crashes?
Well, you would certainly hope. And it seems like we learn a little bit each time. The problem is that we convince ourselves that because markets have changed so much or society has changed so much, we convince ourselves that, the famous phrase, it's different this time. And the markets are certainly different now than they were again in 1907 or 1929, even 1987. So we've learned a little bit, but one thing that repeats itself, and so maybe we haven't learned as much as we might hope, is every one of these crashes has some sort of financial catalyst. Something, you might call it a contraption. There's always some contraption at the heart of it. It's a financial product that's supposed to solve some sort of problem, and when the markets get stressed, they actually tip, the way I described it is, they tip a market on the ragged edge of balance over the edge and into chaos.
Of these 5 scenarios, what if something would have happened that could have altered the course of market history? That's interesting as well. Each of these stories is really, there's no math, few numbers, but there's lots of drama. And each one has a villain, a human being that is a villain and often is largely responsible. Unfortunately, not everyone has a hero. Some of them have heroes. So the interesting thing about this is that there's often a point where if something had happened just a little bit differently, if one person had done one thing differently, then it's not that the market wouldn't have gone down, but maybe it would have gone down over the course of 12 months or 18 months rather than going down over the course of a day or two. Right. Well, it's really interesting to see how the financial markets really do mimic every other part of history because every second can totally change your life.
That's absolutely right. And there are often situations where just a tiny difference would have made a big difference.
And we see that in the electronic markets too, which was what sets up for the 6th crash. I mean, we do have to be realistic about it, where it's coming down to nanoseconds.
Yeah, part of the problem with the flash crash, much of the reason the flash crash happened was because an asset manager wanted to sell $4.1 billion of derivatives, stock index futures, because they wanted to hedge themselves. Well, they didn't have much time, so they turned to an algorithm to get them sold. No human intervention. And the problem is that the algorithm just sold blindly without paying any attention to prices.
And then it breaks below other levels, which triggers other algorithmic programs and some human traders as well.
And what they were doing was they were saying, We just want to focus on volume. We want the market to tell us through volume what it's able to absorb in the form of selling. Well, their selling generated more volume, and so the market was tricked into believing that it could, they were tricked into believing that the market could absorb essentially an unlimited amount of selling, and so they tried to do that.
All right, and where is this available?
It's available on Amazon. It's available in all sorts of bookstores. It's available at Barnes & Noble.
All right, well, thank you very much for joining me at MarketSite.
Thanks, Jill.
Traders, as always, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.